This podcast is intended for investment professionals only. All investing involves risk.
Hello everyone, my name is Andrew Lowry and I'm European Content Manager here at LGIM. This week we're having our quarterly check-in with the world of active fixed income, and I'm delighted to be joined by Marc, who is our Head of European Credit. Marc, welcome to LGIM Talks.
Thank you, and thank you for having me.
Good stuff. We're talking at the very beginning of October, and it's a little bit late to call it late summer, but towards the end of the summer, we did see some pretty significant bouts of volatility driven by a succession of events. We had the elections in Europe, in France, and across the European Union. We had some pretty sketchy labour market data in the US, and then the unwinding of various carry trades. These bouts of market volatility were all quite short-lived, even if they were quite intense, and the market returned to quote-unquote normal pretty quickly. What conclusions do you think we can draw from these episodes?
Yeah, well, I'm not sure we've seen much of a summer here in the UK, but I would say that one conclusion we can draw is just that there's a very strong underlying support, I think. And actually the market very quickly was able and happy to shrug off any concerns. And well, I think to some extent, the market here takes also a bit of comfort from itself. So, yeah, in case any spread widening very quickly gets met by increased buying, that in itself provides companies for comfort, I should say, for traders. And, well, I guess reinforces the feeling that at the end of the day, these are just short-term blips. And that, yeah, I think I would say that conclusion is that the fundamental forces that have been behind the strong performance of investment-grade credit are still very much in place.
Well, the big story in fixed income at the moment is the fact that central banks around the world have begun their easing cycles. And in response, yield curves for developed markets have gotten lower and gotten steeper. Do you think the market has priced in the right pace of rate cuts in the US and Europe now that they've begun?
It's interesting how this has moved around, because we felt that the market was getting ahead of itself at the end of last year. There were 6 or 7 rate cuts priced in for the US as early actually as the end of February, beginning of March, and we felt that was a bit overdone. And we were happy to take some profits also and reduce duration somewhat at that time in our portfolios. Then the pendulum moved to the other side, and at the end of February there was only something like 3 cuts priced in, only then to move back later on. And I think where we are now, after the 50 pips we've seen from the Fed and the 2 also rate cuts by the ECB, there's again something like 6 or 7 cuts priced in, which looks like a lot. So I must say, I feel we need more economic weakness than is currently expected than to actually get that delivered.
And for 2 years now, spreads have been supported by the amount of inflows coming into fixed income. What's been lying behind that, do you think?
I think a lot of that has to be explained by the higher yields. We obviously come from an environment where, especially in Europe, there was hardly any yield. We were below 0.5% on investment-grade credit, and then we went as high as over 4%, even coming close to 4.5%. Until, let's say, the beginning of, or the end of last week, we were still somewhere around 3.4% or so. Now, obviously, we are seeing a bit more of a rates rally over the last couple of days. But yeah, the yield story, the yield is back, the income being back in investment grade has to be part of that story. And I think what's maybe almost exaggerated that a bit is, well, what we call the FOMO, the fear of missing out. So rates coming down and people being afraid that actually by not being invested, they may have missed an opportunity and want to make sure that they still got enough duration in their portfolios to lock in these yields for a longer time period.
We've just been working together on your outlook for the fourth quarter of the year. And there's quite a striking statistic in there that by this point of the year, the end of Q3 into Q4, 2024 seemed the highest ever volume of new bonds issued by this point in the year. Why do you think that is?
Yeah, it's an interesting question. I had a bit of a look at that. And well, I think one of the things, obviously, you have to take into account is that the euro investment-grade credit market has grown a lot. And we're not talking about a market which is almost 3 trillion in size. So a bigger market itself will also induce, if only by refinancing, a higher volume. If you compare to another record year, which was in 2020, I think what's a bit different now is that it's not non-financials, not just non-financials, but we see actually more bank issuance, financial issuance, both banks, but also real estate companies. The market was closed for them effectively for a prolonged time period. And now the market has reopened again over the last couple of months. And they are obviously making very actively and aggressively use of that opportunity. So, yeah, I think that the reason is, I think the market has grown a lot. Also, maybe what's part of the reason is if you look at net supply is actually not that high. And I think that comes back to what I was saying about the size of the market. But also, if you think that a lot of issuance was in 2019, 20, and quite of that will be sort of 5 to 7 year papers. So quite a bit of that high issuance we saw in those years will actually now come to redemption and needs to be refinanced. And maybe I should add to that, maybe on the company side, treasurers also feel that with rates coming down, actually financing conditions are potentially maybe pretty attractive. So with these lower yields and spreads also being not that high, they, I guess, are also quite happy to lock in funding for longer time periods.
That's fascinating. Now, the million-dollar question is whether or not this soft landing narrative will sustain itself and come true. It's ebbed and flowed on the back of various different contrasting data releases over the last few months. Overall, do you think the market has sufficiently priced in the risk of recession?
I wouldn't think so. And we have some doubts about it. And I think that comes back to what I was saying. If you look at the number of rate cuts, it's hard to reconcile that with a scenario where growth will not disappoint more than sort of what you would expect in that soft landing scenario. I also think there's not enough difference between high and low quality. We've seen a lot of compression. Triple B has outperformed single A materially, and we're talking about 20 bips or so around that level since the beginning of the year, even more. You look at the difference between high yield investment grade. A lot of this actually suggests that there's quite a bit of, let's say, of that soft landing narrative, of that positive sentiment priced into the market. And while I and we as a team feel that the market is underpricing actually the risk that landing may be a bit more bumpy than what's currently expected.
Can you tell us a little bit about how you've positioned your portfolios to manage that risk? Are there any industries or sectors you've been leaning toward or leaning away from?
Yeah, it comes back to what I mentioned about the difference between triple B, single A's. We are now very much focusing on the higher quality part of that universe. Very little in, let's say, below investment grade crossover. Again, because we do see the best value actually in the high triple B or single A or even above part of the market. In terms of sectors, we like defensive sectors, we like utilities. Utility spreads are relatively wide because there's a lot of supply in the sector, which has partly to do with electrification and the amount of investment that these companies need to do. So, yeah, that itself, I think, is part of the reason you have a bit of a premium on the sector. And as I mentioned, it has these defensive characteristics, which I think, for instance, were very clear in the first quarter of 2020 when COVID hit the market. We've taken profits on banks. We've been overexposed in banks or sort of had a higher weight than the benchmark, substantially higher also at certain times because bank paper was relatively cheap. While banks have outperformed and it's no longer cheap. At the same time, it's a cyclical play in the economy because of their loan portfolios. So we've taken profits there and we've reduced the overweight, and we are actually now more neutral again with a bias to quality. And I think at the end of the day, the main, I would say, defense against a more negative economic scenario is the work by our credit analysts. It is the bottom-up analysis they do, making sure that we at least avoid the companies that are not performing as they should.
One of the biggest stories this quarter is going to be the election in the US. We're about 5 weeks away at this point, but you obviously manage European portfolios, but this will be affected by the result either way. What kind of scenarios are you preparing for?
I I think a multi-asset team tends to say, you don't predict but prepare. I think you have to acknowledge in our portfolios, there's about 20% US companies, which is a decent chunk. I would say also here, you can think in scenarios, you can think about maybe the risk of a more protectionist policy when Trump would win the election. But I would say overall visibility is limited. It's not fair. I would say we don't try to predict, and we prepare in the same way as we prepare for a scenario where maybe you don't have a soft landing but a more bumpier landing. Is the focus on quality? Is the credit selection? Obviously, we do look at names and sectors that will be more affected by sort of more protection, higher tariffs. The auto sector is one that, for instance, comes to my mind here. But yeah, I think it doesn't really change so much the way how we invest and how we construct our portfolios.
Sure thing. Final question. You mentioned soft landing, hard landing just now. When will we know? I mean, will we know by Christmas?
Yes, I would think we do, because I would say when I look at the data at the moment, one of the things I focus on is, for instance, the manufacturing sector and the weakness in manufacturing. And it's been the services sector which has held up very well, especially when you look at the US. I would think that that weakness in manufacturing, we will have to see at some point whether that will continue and whether that starts to feed through in more layoffs, higher unemployment, weakness in the labor market. At the same time, we see now, obviously, the stimulus in China. That can, to some extent, maybe counterbalance some of that weakness. And I'm thinking especially about Europe, sitting between the US and China here, especially Germany, with its heavy reliance on manufacturing, but also being very much linked into China. In Europe, obviously, we've already seen the substantial weakness when you look at Germany and you look at the manufacturing indices, which all looks very weak. And my feeling is that we didn't see more weakness in spreads, partly because of the strengths in the US. And also, I think, coming back to what I mentioned earlier about the market technicals, the strength of the demand, which is partly driven by these more attractive yields that we're seeing. But yeah, I would expect in the next couple of months we will see more evidence about what scenario is actually going to play out, whether the soft landing is going to be more bumpy. And one of the things I will closely look at, and that again will also rely on the work of our analysts, is when Q3 company results come out, because typically macro numbers, if you look at the employment numbers, they are typically lagging. But I think the results that come out and what companies will be telling us, company forecasts after the Q3 numbers, I think that will be actually very telling and could be very, let's say, useful in terms of giving us some further guidance. But yeah, at the end of the day, it's forecasting is notoriously difficult, and without trying to be too confident in terms of our abilities to predict, I think we can very well prepare.
That's a bravura overview of European credit. Marc, thank you so much for your time.
Pleasure.
As a reminder, this podcast is intended for investment professionals only and shouldn't be shared with a non-professional audience. The views expressed in this podcast are those of Legal & General Investment Management Limited, as at the date of publication. This podcast is for information purposes only, and we are not soliciting any action based on it. The information discusses general economic, market or political issues and/or industry or sector trends. It does not constitute research or investment, legal or tax advice. It is not an offer or recommendation or advertisement to buy or sell securities or pursue a particular investment strategy. Assumptions, opinions, and estimates are provided for illustrative purposes only. There is no guarantee that any forecast made will come to pass. No party shall have any right of action against Legal & General in relation to the accuracy or completeness of the information contained in this podcast. Where this document contains third-party information, the accuracy and completeness of such information cannot be guaranteed, and we accept no responsibility or liability in respect of such information, not for distribution to any person resident in any jurisdiction where such distribution would be contrary to local law or regulation. Copyright 2024. Legal & General Investment Management Limited is authorised and regulated by the Financial Conduct Authority. In Hong Kong, this material is issued by Legal & General Investment Management Asia Limited, regulated by the Hong Kong Securities and Futures Commission. For full terms and conditions, please visit our website. To find more content, you can check us out on X, formerly known as Twitter, LinkedIn, and our website.